Okay. Now, you helped 15 of the 19 banks in one form or another.
Yes.
Okay. Of the 15 banks, where was your typical point of engagement? Who called you in? Who did you have your initial meetings with? Who did the bank normally appoint to sort of, to drive this through?
That varied across the board. QRM is very well known for, originally for asset liability management. 8 years ago we added credit risk management, and obviously the stress tests here involve economic factors and credit risk. So our clients predominantly use us for asset liability management, although four of the organizations that had to do the stress test had already engaged us for credit risk management. So typically we came in from the asset liability management side, which is the side that runs the scenarios. And we had to work on a couple of different areas, both on helping them generate economic scenarios as opposed to interest rates or exchange rates, and then on the modeling side, parameterizing either their internal models from a different group, the credit group, which I have a commercial modeling group typically and a consumer modeling group with different model frameworks, and showing how to plug those models in so that we can calculate valid numbers going forward, or actually building some of the core models in cases where we had to fill in some of the gaps. So it was all over the board, and it was a bunch of interesting exercises.
Right. So that's the initial point of engagement with with the people you've already been interacting with at the ALM level.
Yes.
Now, however, who would the coordinator be typically in an institution that you ended up having to work with to get information from all the different moving parts?
Well, we work, of course, primarily point people with the people who we're engaged with. But as part of that process, we came to the table with, in several organizations, with brand new people who our own clients had never even met. In some cases, the balance sheet, the asset liability management group, we're meeting for the first time with the commercial credit modeling guys and the consumer credit modeling guys in order to get together to parameterize the models in such a way as they could generate a stress test that's based off the economic drivers. A couple of cases we started on the credit side, and they needed help bringing the asset liability management teams in so that they could generate the consistent forecast.
Right. Of the institutions that you worked with, what would you say was the quality of the baseline data that was available, and how many of those institutions would you say have to do more work, for example, over and above what needed to be done to qualify for to provide the data for SCARP?
It was all across the board, and I think universally what is going to come out from this process is the realization that these groups need to be working together. The old silo-based approach where you have pockets of expertise are just going to be a thing of the past. So that has already been the trend, but the stress test is only going to accelerate that. So there's going to be much closer collaboration between the asset liability management group, the credit group, the regulatory capital group, the market risk group. There just has to be. Initially, I was interested to see that a lot of these organizations were thinking, oh, I'll just get this test done and it'll be over with.
Right.
So Charles, we already did our test. We don't need, we only need you for, a couple days on this. And I'm thinking, okay, well they can't be thinking that this is a one-time thing. Obviously, it's one of these things that they should be looking at on an ongoing basis. And depending on the quality of the way that these models were built and put together, the results are very subject to key assumptions and key drivers. Right. So I know in one particular instance where the internal group came up with some numbers, we helped our group come up with some numbers, and external highly paid consultants and third parties came up with another set of numbers, and all three of those numbers were different.
Okay. Tell us a little bit about the modeling process. How much of that involved negotiations with the regulator, What was the toing and froing mostly about, and are you happy with the kind of models that had to be developed for this program, and are they usable going forward?
I think the entire process is going to be a net benefit for the industry. This, of course, is going to be trickling down. A lot of organizations are already doing stress tests, and of course, of the 19 that were required, they were all doing some type of stress testing. We let our organizations deal directly typically at a very high level with the regulators. So we were called in, of course, to back up assumptions and models and strategy and procedures, as well as a few other things with our individual clients. I would have to say that one of the takeaways from this whole process is going to be an internal reworking on the models themselves, and it's going to result in more scrutiny and hopefully more transparency and the elevation of the need for being able to pull this stuff together. So a lot of the models, I would say, have plenty of room for improvement.
Right.
A lot of them were, in the end, despite the possibility of doing it properly from the bottom up and getting the true feeling of how, calculating the numbers of how these drivers would roll through your whole balance sheet, everybody liked the idea and wanted to do it. But within the time frame required, and with all the complexities and all the moving parts, I would have to say that a lot of organizations stepped back and relied on some top-of-the-house,
right,
more generic assumptions.
Right.
And I'm probably certain, if you ask these organizations if they think they had a little bit more time, would they be able to come up with a better forecast?
Right.
The answer would be predominantly yes.
How different has this process been with banks that want to qualify for advanced IRB, for example?
Well, the U.S. top banks had to all be advanced IRB. And they, of course, were in better shape for having the core assumptions ready for Basel Pillar 1, as we mentioned earlier, the PDs and the LGDs, and looking at their data in the proper cuts. I mean, in the asset liability management world, sometimes people don't do the cut for commercial credit grades or internal models. They can overlook it. The credit guys do, but then they don't do the forecasting piece. So one of the reasons the market risk and the asset liability team wouldn't break out their products by credit, by their internal scorecards or by their internal credit rating schemes, is because they didn't have access to the data, and it was because the credit guys wouldn't give them the data, or they didn't have the data. So the fact that it was possible for them to have the data already, even if it were very simple lookup tables that you could put in Excel, that greatly facilitated the process, because as part of the stress test, you build the macroeconomic models that do things like, as housing prices go down, people's loan values go up, and someone becomes more likely to walk away from their loan. But that's typically varies by whether they're a good borrower, a bad borrower, an ugly borrower. So I mean, this sort of a merging of the credit and the ALM world needs to take place. Then you have the quantitative modeling groups that have these roll rate type models and these migration type models that need to be plugged in. So it was really, an exercise in pulling the right people together.